Welcome back to our series on Introduction to Financial Services Industry. This is part two of our videos on cryptocurrency and blockchain. Just real quick to get back into our conversation. Same disclaimer, this is just a basic introduction and we're not going to offer any financial advice. And all this information is already available on Investopedia if you're interested. So let's get started. So let's talk about Bitcoin, right? So Bitcoin was the first of the major cryptocurrencies to really capture the public imagination and take root and grow. It was really the first big one. And it all started with an individual or a group that operated using a pseudonym of Satoshi Nakamoto. Now, there had been a group in the 90s getting together in Silicon Valley, and they called themselves the cyberpunks or crypto punks. But what they were was they were a loose organization of technology leaders in the Silicon Valley who would get together once a month to meet and have lunch and discuss cryptology. How do we keep secure the network? How do we keep secure the internet? And they would kick around a lot of ideas. And one of the ideas was this idea of a cryptocurrency. But it kind of faded away. It was an academic discussion, and nothing really happened with it until in 2009, Bitcoin came about. Now, how did Bitcoin come about? Someone or a group of people from that original group in the 90s that was discussing this, using a pseudonym, using the name Satoshi Nakamoto, published a paper in 2008 called Bitcoin, a peer-to-peer electronic cash system. And the paper outlined exactly how Bitcoin would work. It provided sample code. It described the whole thing. And it outlined everything. And what happened was several people from that original group took the paper, actually launched Bitcoin, and in 2009, and Bitcoin became a reality, became a thing. Now, why 2008 and 2009? The timing here is significant because at that time, there was a financial crisis in the United States. It was the banking crisis of 2000, 2008, 2009, and that had its genesis in the bank's overreach in the mortgage markets. And we had a terrible crash in the mortgage markets, created a banking crisis. Some large investment banks, were wiped out as a result of it, right? Lehman Brothers would be one example. So there were firms, there was a great deal of distrust in the banking industry, the banking infrastructure in this time period. There was a distrust of the Federal Reserves. And as a result, the timing was right. The soil was fertile for this concept of a cryptocurrency that existed outside of the banking infrastructure, outside of the Federal Reserve Bank, outside of the concept of centralized banks. And that's why the timing was so important. So in 2008, the paper is published by this Satoshi Nakamoto pseudonym, which was either a person or a group of people. The paper outlined how Bitcoin would operate, provided sample code. And then in 2009, Bitcoin actually, the first Bitcoin transactions were created. So, what is a Bitcoin? So I like to start with just this picture because we always see, on the internet, pictures of Bitcoins. And, I know this is, most of you already understand this, but there is no Bitcoin. There is no physical thing that you can hold in your hand that represents Bitcoin. Bitcoin is not a physical thing. The first Bitcoin, Bitcoin was the first and largest of the digital currencies. It exists in the ethos. It does not exist as a physical coin or a physical piece of paper or any physical reality. Now, following Bitcoin, there were many other cryptocurrencies created that exist electronically, and the cryptocurrency market had grown to over $1 trillion in market capitalization. And it's funny because when I was first looking at this presentation on December 3rd, 2021, Bitcoin itself had a market cap that had just exceeded $1 trillion in market capitalization. Now, after that, it went down and it dropped down slightly after that. But there's a huge market cap in cryptocurrencies out there today. Underlying to cryptocurrency is this concept of the blockchain. The functionality of Bitcoin and others are similar, and they're widely used. They widely use blockchain technology. So, for instance, Ethereum, Bitcoin Cash, which is separate from Bitcoin, Litecoin, and other cryptocurrencies. So not all cryptocurrencies have to use blockchain, but blockchain, as outlined in Satoshi's paper, is a widely used technology for cryptocurrencies. So who controls Bitcoin? No one controls Bitcoin. There is no single person, entity, organization that controls Bitcoin. The fact that Bitcoin has no control or administered, or it's not controlled or administered by any bank or government entity is part of the appeal. Now, that's what draws people to cryptocurrencies, and Bitcoin in particular, is there is no centralized control. Now, there are other cryptocurrencies that do have some centralized control or some centralized administration, but Bitcoin and many others have none, and that's the appeal. So it's completely uncontrolled. It just exists in the internet, in the virtual world, which is also why it's so appealing for criminals. So this is why the dark web rather, uses cryptocurrencies for drug transactions, or it uses it to pay a ransom for ransomware, or it uses it to pay ransom for people, when people are ransomed. Bitcoin is very popular because it has no central control and it can't be tracked easily. So how is Bitcoin value determined? All right, well, I have to say that Bitcoin value fluctuates radically, okay? And the argument would be, in the old days, if you remember in the part one of this series, I talked about specie currency, where gold coins, silver coins, copper coins, where the currency had a value based upon an intrinsic a value of a coin or other object. And then we talked about where the currency is a paper currency, but it's backed up theoretically by gold in Fort Knox or something else. And then we talked about fiat money, which is where the money is basically just issued by a bank or a government, and it has value because the government says it has value. So money has value because people feel it has value. And that's how cryptocurrency works. The value exists because people place value on it. So digital currency fluctuates differently from traditional money. The price of a Bitcoin is determined by the supply and the demand on the exchanges where it's traded, while the buying power of traditional money is fluctuated by factors such as central banks, monetary policy, inflation, and foreign currency rates. Bitcoin doesn't have that. It just exists and has the value that people place on it in trading it in the exchanges. So in this example, Bitcoin, when I checked it on December 10th, 2001, it had a price of $48,170.60. But if you see from this chart that goes back over a longer period, you can see that the huge fluctuations in the price, ranging from around $10,000, going up as high as 60,000. I'm sorry, that's 80,000, dropping down to 40,000 and coming back up to 50,000 and then settling around 48. So this is a wide, very, 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 very volatile pricing. Now I have another longer term chart. This chart goes from December of 2013, where cryptocurrency values were following it all the way up to December 7th of 2021. So this goes to show the skyrocket value. So what's behind cryptocurrency? There's no currency behind it. There's no gold behind it. There's no precious metal. There's no commodity. There's no government. There's no stock. It just has the value that the internet, that the population, that the supply and the demand place upon it. So it's really kind of a different concept. Okay, let's moving on. So Bitcoins aren't printed by any government like the Treasury does. It's produced by people and businesses using computers all around the world, using software that solves complex mathematical problems, those cryptology problems, right? The mathematical formula is freely available. Anybody who wants to see the formula used in processing Bitcoin can download it off the internet and can be checked. But problem is, in order to solve the equations, the mathematical equations for the cryptocurrency, for the processing of a Bitcoin, for the validation of a transaction, you need a really super powerful computer. So people who process Bitcoin transactions and try to earn Bitcoins, to have new Bitcoins created, are called miners. So let's talk a little bit about mining Bitcoin. So mining Bitcoin is the process where someone takes their computers, they're very powerful computers, and they use them to process Bitcoin transactions in the world to the whole global network. And if they do the mining correctly and they're fast enough, they will over time earn Bitcoins and earn Bitcoins and to earn value in the network. So let's explain this. Bitcoin mining is the process by which transactions are verified and added to the public ledger, known as the blockchain. So the public ledger is the blockchain. This also is how new Bitcoins are created. Anyone who has access to the internet and has suitable fast computers can participate in mining Bitcoin, processing these transactions. The mining process involves compiling recent transactions into blocks and trying to solve computationally difficult puzzles. That's that cryptology. The participant who first solves the puzzle gets to place the next block on the chain and claims rewards. The rewards, which incentivize mining, are both transaction fees associated with transaction compiled in the block, as well as newly released Bitcoins. So why do people process Bitcoin transactions? They do it to earn Bitcoins. Now, when Satoshi created the paper that outlined Bitcoin, right, he put forward this idea that you would mine Bitcoin transactions and earn Bitcoin. But he also had the idea that, so for instance, you would get 200, if you did 210,000 blocks, you would be awarded Bitcoin. But he had this idea that about every 4 years, but every 210,000 blocks, the amount of reward earned would be halved. So the block reward in 2009 was you'd earn 50 Bitcoins. In 2014, it was halved to 25 Bitcoins, and it will continue to decrease. So the idea is initially mining Bitcoin transactions, you would earn a lot of Bitcoins. But as time goes by, you earn fewer and fewer Bitcoins with the idea that eventually that would go away and be replaced by some other means of incentivizing people to be miners, to process the transactions, right? So Bitcoin creation. So I just talked about that. I need to kind of explain it in detail now. So let me explain it. Let's say we got two parties, Tom and Brian, and Tom wants to send a unique Bitcoin from his secure wallet to Brian. So they both own Bitcoin, they both have wallets. So Tom is going to send a Bitcoin from his secure wallet to Brian. Now, the software, Bitcoin software in the network, bundles this transaction along with other transactions into a block and transmits this block to a network of powerful computers for verification. So computers all over, all the computers in the Bitcoin network. Remember I said that network is open to anybody who has fast enough computers and wants to load the code. So that transaction is bundled into a block, and the block is sent to all the computers in the network. Now, once the computers in the network get that transaction, get that block, they're all going to be in a race to see who can solve that really complex mathematical equation, that mathematical puzzle required for the crypto validation that the block and the transactions are valid. So computers in the network race to verify the block of transactions, to make sure there isn't anything, any hacker sticking anything in there, anything that's a corrupt or illegitimate transaction. So all the computers in the network have the transaction, the block of transactions, and all the computers in the network are trying to validate that it's correct. Once someone has proved that the block is valid, that it's not, there's no hacking in there, it's a valid block, right? It then is added to the entire ledger of all of the Bitcoin transactions. And that ledger is the blockchain, right? So this new block of things is added to that ledger. And that ledger is distributed. Now this is the updated ledger. This is now the correct ledger. That ledger is now updated to every computer in the network that for future use and validation, right? So now everybody in the network is operating on the same common ledger of all Bitcoin transactions. That's the blockchain. And that's used for future transactions of processing the next block of transactions. Now the miner whose computers are the first to verify the transaction and maintain the block, they win Bitcoin. They win a chunk of Bitcoin. And a new Bitcoin is now created and added to the ledger. So that's how Bitcoin transactions are used to create new Bitcoin. And that's the function of the miners. The miners are people who on their own operate their fast computers as part of this larger network of computers worldwide. Now, those computers have to be very powerful, and they also use a lot of electricity. So it isn't like this is free for the miners. The miners have to put resource into it for the purpose of earning Bitcoin. And but as a result, they provide infrastructure that lets Tom and Brian send their transaction. and have a valid transaction processed in a highly secure and fast manner. So Bitcoin and blockchain technology. So we've talked a little bit about Bitcoin. You know, the central to the genius of Bitcoin is the blockchain. This idea that we have a chain of transactions, of blocks of transactions, and that this chain of blocks of transactions operates as a ledger that exists in multiple locations. So there isn't one place with one ledger. It's one ledger that exists with copies in multiple places, and they all have to agree that the ledger is correct. If one party in the network has a ledger that doesn't match what everybody else has, he's invalid. He's kicked out of the network. Many experts see blockchain as having important use in other technologies, right? So there's other things outside of cryptocurrency, outside of Bitcoin, that blockchain can be used for. And there are firms like JP Morgan Chase, other firms who are using it for other things. But it's this idea of multiple blocks linked together in a chain. I'm going to talk here real quickly about the concept of a ledger. So now that I mentioned the ledger and the chain, I want to kind of tie it back in terms that people can readily understand. Ledger books have existed for hundreds of years, right? You have this book, it's a ledger, and it holds an image, it holds transaction records, and accountants have used it for hundreds of years. And what you do in a ledger is you list all the transactions, you list all the debits, and you list all the credits. And someone who wants to recreate or wants to audit your holdings can go back in that ledger and can redo all the, reprocess all your transactions and see what they come out with as a current total, right? So if I've got a ledger that lists every time you've had a debit and every time you have a credit, I can go back in that 8-point history and replay it as an audit to make sure all the numbers tie out right? So a ledger provides a sequential record of transactions. Balances and holdings can be reconciled and audited via this view of these transactions. That's what those old books were for. That's exactly what we're doing now electronically with the blockchain as an electronic ledger, right? So just as in the old days, the ledger books were numbered, right? You had each ledger book was numbered, so that if someone was going to go look and tamper with your books, you would refer to the books as in their order of their numbering, so that you knew that you were handling them correctly sequentially. And also, every page in those books was glued in. If you go to a supply store and you buy a ledger book, you go to a Staples or any stationary supply store, you can still buy these ledger books. And you'll notice that the pages are all glued in and sewn in. So you can't tear a page out. Because if you tear a page out, you now know that the ledger book has been tampered with, and you have to question the data that's contained in it. So for instance, those old ledger books, every page in the ledger book was numbered. And that numbering actually created a chain, right? Because you went from page 218 to page 219. And if somebody saw that a page was missing, if I was going and I was auditing somebody and I was going through their ledger and I was looking at all their debits and all their credits and all their holdings, and I processed page 214, 215, 216, and then I got to page 219. I'd say, wait a minute, something's wrong here. I'm missing a page, right? That's the same concept we have in a blockchain. It's a chain, everything's sequential, and you can't break the chain. And if you break the chain, the ledger's not valid. And that's how we work here, right? So if you look at the nature of a blockchain, in the case of Bitcoin, right, we have multiple transactions, and they're kept in blocks, and they're all linked together. and they're linked from one key to the next transaction that has to be verified, right? And this is a better example, I think, this diagram. Each block in the chain is linked to a proof of work for the previous block, right? So you go from block 51 to 52, 52 to 53, 53 to 54, where the proof of work in one block is used in the next block, and it maintains integrity. So if a hacker were to break in here, and a hacker were to go and submit a fraudulent block, they wouldn't have the correct data, that mathematical solution. They wouldn't have the correct solution to provide the link to the previous block. And once they do that, you know the chain has been broken, and what piece is being added is not valid. And that's the key to this idea of a chain of transactions. As long as it's been validated, it gets added to the chain. And you know that the ledger, think of each of these blocks as a page in a ledger book. As long as they are, the proof of work matches the previous block, you know that it's a valid chain, and you know that the blocks and the data in that ledger is correct. And each block contains multiple transactions. So that's the idea of a blockchain. Let me go through an example here, and hopefully this will be easier to understand. Let's say we've got Tom and he wants to send Bitcoin to Brian, and he's got his wallet, and the transaction is represented online as a block. And the block is broadcast to all those super smart, super fast, super powerful computers all over the world that are in the network. Those are my miners. So all those computers globally now start going to work, trying to process this transaction along with all the other transactions in the block. And those in the network approve the transaction, and they prove out, because they go through that complex mathematical problem, and they solve the equation, they solve the problem, they solve that cryptology, and they validate that yes, this is correct, and the block gets added to the chain. So this new block is now added to the chain, forming the ledger, the global ledger. And everybody who participates in the network, all those computers, all those highly fast computers, all those miners in the network, they all now have their own copy of the ledger, of the blockchain. So it is not a situation where there's one ledger that someone can hack. That's not what's happening. What's happening is everybody has a copy of the ledger, and everybody works to verify when a new block is added to the ledger. And when it's agreed upon that new block is validated, everybody now has the new ledger. So this makes it much harder to hack. And then what happens is the Bitcoin is moved from Tom to Brian. So at a high level, that's how a Bitcoin transaction gets processed. And that's how the ledger is used. And that's what the miners do. And that's how this is processed. So Bitcoin versus Bitcoin Cash. This is a slightly different topic. I wanted to explain this idea of a splinter or a fork. In cryptocurrencies, not just Bitcoin, but others, you'll find that sometimes a currency will go on and it will splinter. It'll fork. It'll end up, a new currency will be created from it. And that's kind of what happened with Bitcoin Cash. Bitcoin Cash is not Bitcoin. It's a new Bitcoin. It's a new cryptocurrency created. So Bitcoin splintered and forked, and Bitcoin Cash was created as a new cryptocurrency in 2017. And what happened was there were people who felt that Bitcoin didn't have enough space, didn't have enough cache space to hold transactions. It wanted to hold more transactions. It wanted to increase the number of transactions that could be held in each block. So they basically came up with a version of Bitcoin that had more cache space for transactions. And they split off from Bitcoin and created Bitcoin Cash as a new cryptocurrency, right? So that's what Bitcoin Cash was. So it's a different cryptocurrency. It is not Bitcoin. It's a different entity. It's a different cryptocurrency, but it was a splinter or a fork off of the original classic Bitcoin. I hope that makes sense. And there have been other splits of other Bitcoins. Now, we got to talk quickly about risk. Risk of investing in Bitcoin and other cryptocurrencies, right? Some speculators have been drawn to Bitcoin trading as a way to make quick profit. Like most speculative investments, you need to be very careful. Buying, selling, and using Bitcoin carry numerous risks. Among them is the price of Bitcoin and other cryptocurrencies can fluctuate unpredictably and drastically. So there's a lot of fluctuation, right? Digital currencies such as Bitcoin are not legal tender. You can't pay your taxes with Bitcoin. You can't, they're not a legal tender. No law requires companies or individuals to accept Bitcoin. You can't walk into a pizzeria and demand that they pay for your pizza with Bitcoin, right? So that's another risk. Platforms that buy and sell Bitcoin may be unregulated, right? So they could be hacked, or they may be stopped from operating or create failures in processing. Digital wallets can be and have been hacked. So there's a risk to there. Bitcoin transactions can be subject to theft and fraud. For example, a fraudster could pose as a Bitcoin exchange, a Bitcoin intermediary or a trader in an effort to lure you into sending money, which then could be stolen. So there is fraudulent activity out there. Unlike banks or institutions that provide FDIC insurance, there's no safeguards to digital wallets, right? If you put money into a bank and that deposit could be FDIC insured, so if the bank were something that happened to that bank, the federal government will insure up to some point your deposits. Well, you don't have that with Bitcoin. Deposits are not insured. The other thing is Bitcoin payments are irreversible, right? Once you complete the transaction, it can't be reversed. So if someone has you send them Bitcoin and it's fraudulent, and they're basically stealing from you, right? Somebody says, well, I'm an exchange, just send me your Bitcoin and I'll help you sell it. And then they basically get your Bitcoin and they just take it and keep it. You can't reverse that transaction. It isn't like when you're buying stock and you got T+2, there's a period of reversals. You can do corrections. There's nothing like that. It's irreversible. Once a payment is gone, the payment is gone. So there are risks to cryptocurrencies. So when you're going to do investment in cryptocurrencies, you should do your research. And anyone thinking about investing in Bitcoin or other cryptocurrencies, you should deal with professionals. You should contact, whether it's Toronto Dominion or Merrill Lynch or Charles Schwab or Fidelity Investments. You should be dealing with somebody who's trusted. You be very, very careful with somebody you find on the internet. That would be my one piece of caution. Although I'm not making financial advice. I'm just cautioning you to be careful. There are other cryptocurrencies out there: Ethereum, Ripple, Bitcoin Cash, Neo, Litecoin. Every time I turn around, there's a new cryptocurrency. So if you go out and you do your research, there's lots of different cryptocurrencies out there, and they're all slightly different. One other comment I want to make in conclusion is it's interesting to me that the original idea that Satoshi put forward was that cryptocurrencies would exist as a way to transfer value over the network, peer to peer, and disintermediate the banks, disintermediate the exchanges, disintermediate all the intermediate parties, and really eliminate speculation. It was just a way to transfer value. And what crypto has kind of evolved into is this highly speculative market where there are intermediaries, there are exchanges, and there is this wild speculation. And a lot of people are putting money into cryptocurrency. They have no desire to use it as a tool for transferring value in a transaction between two peers. They're not trying to do peer-to-peer transfer value. They're trying to use this as an instrument for investment and speculation, which is exactly what they were not trying to do, what Satoshi and his group put forward, or her group or their group put forward in the original concepts. So again, I'm Paul Judge. I hope that helps. I know there's a lot of information there, and I know it's a little bit confusing. If you have any questions, please send me an email at paul_judge@alumni.shu.edu, or you can contact me via my LinkedIn page. As I've mentioned on other occasions, I am an independent consultant. I am available to do contracts and advice and training, and contact me if you're interested in doing that. So with that, have a nice day, and I hope this was helpful.